This is Justin Pulitzer. This is my weekend review video for Sunday, February 21st, 2016. A good amount to cover, but I want to start the video off with saying if you happen to be seeing this and the YouTube resolution is low, just pause it or come back in a little while. I am shooting this, believe it or not, in 5K. YouTube doesn't quite support that, but it does support 4K, up to 4K. So if you're having trouble with the resolution, just wait a little while and the resolution will catch up. This is nothing I have control over. It's just a matter of when YouTube is done with the upload and how quickly they make the higher resolution versions available. So that being said, that's that. Anyhow, let's jump right in. This was a interesting week in the sense that we had some Fed minutes. I'll talk about my take on that in a little bit when we get there, but let's start out with the 6 market keys here with the VIX for starters. So some good news with the VIX for, I guess, for longs, for the bulls. By the way, I created a VIX key here. A lot of people had been requesting it, and your wish is my command in this instance, and I created for you a VIX index of how I view the VIX and my opinion on when to kind of play more directionally with options, and then when you might want to sell some premium, and then kind of what the VIX might be. So first and foremost, 0 to 15 is low. You want to play directionally, meaning long calls, long puts, or long spreads. 16 to 17, I'm sort of still thinking that's when it's sort of getting to be fair volatility. 18 to 19 is more medium. That's when you want to start selling premium, out of the money, naked out of the money premium or spreads. 20 to 22 is elevated. That's usually when you got a little fear into the market and you definitely want to use that to sell some premium. 23 to 25 is really the high end of range for healthy panic. You can see up here, this is kind of been where it's topped out here. You can see in like the 22s to 25s. Look where that is with this elevated or the high end of range. The problem happens is when you get above 25 to 31, you really have crash risk. And you can see here when we closed this Friday above the 25 comfortably, we had the flash crash on Monday, and you can see where that led us. So anything above 31, you're probably in the, the crash is probably already underway. So that's the VIX key. Anyway, with regard to the VIX, you can see this is a long-term chart. We were in a period of fairly sedate volatility. I don't know why I drew that in. I guess I just drew it by mistake. But you can see volatility was rather low. We've had some periodic spikes, but it's been fairly contained. And now we have a bit of an issue. We had a bit of a look below range here fail, and then an explosion in volatility, came back, rallied again, came back, rallied again to now look higher highs off higher lows. The danger we risk here is a transition from volatility from benign to more active. And you can see it. We seem to be going through a period like this. It did calm down again, so the jury is kind of still out. I mean, you could see, look what happened here. You had the big spike relatively. This was dramatically larger. But if you take out kind of the excess here, look where these tails kind of like topped out here. You had one of these, this kind of a move here, and then a period of more benign volatility. I don't know if that's not going to be playing out again here. We'll have to see, because look what you had here. You had the run-up of the higher lows. However, here you also had a bit of higher lows, but it did come back together. So we'll have to see. It's still a little too early to make that call. We did close on Friday here, still above 20, which is still elevated, which means there is still some risk in the market. The market has really done what it should do. You got the 31s. You broke down. You got your retest of 35s here, a little bit of a lower high, and then came back down. 25s and then 22s supported initially, and now you're back to 2020 as a support. What could happen here is you could have a pop back up to like 22, 23 and then roll over, or maybe this continues to keep going down. Wouldn't even surprise me to see a move back to the lower end of the range. But volatility is definitely receding here a little bit, and we are below a couple of important moving averages, a 20, which is now downsloping, a 50. You still have 100 and 200 MA support. You can see 200 MA here was kind of important. It might want to retest down there, and That's currently in the 18s, which would be consistent with a move back to kind of the midpoint of the range. So let's see how that plays out. The dollar. So this could be the great villain of, I would say, this was really the great villain of 2015. 2014, 2015, you could see this really took off. That's really when the market started getting a little, I wouldn't say coming unhinged, but definitely wasn't going up anymore. And it's been in a bit of a choppy pattern. It looked like it was kind of breaking out here, but it came back into range, tried to break out again, lower high, now lower lows. That's a good pattern if you're long stocks. You don't want to really see a strong dollar. You have other countries devaluing currencies at an alarmingly quick rate. We are, of course, in a tightening policy with the Fed, and that has kept a bid under the dollar. It's amazing. The Fed had said that they were nervous about a strong dollar, but then went ahead with their rate hike anyway. I'll get to that in a little bit when I talk about the 6 and the really the 7 Fed keys, but the 6 official ones. So the good news here is that the 200 MA had supported here. We haven't even really been able to muster a rally there, and then the low here was 25.06. The low here was 25.06, and the close was 25.07. So the this week's range sort of held. It's going to be important. If we can lose this, that would be good. If these days here, though, get taken out with a violation to the upside and a close over the 200 MA, I don't want to say people are going to lose their you-know-what over this. We'll just keep it clean. We'll say lose their head over it. But I think that will get people a little bit concerned that the dollar is going to try and rally again. So let's keep an eye on this week's range. A violation below would be good. A violation to the upside would, I guess, be more concerning. Keep an eye on this 25.23, and the 200 MA is 25.27. So between 25.23 and 25.27, you really don't want to see the this get much above there. You can see 25.25 here resisted. I guess, sometimes these levels are off by a little bit. It just happens that way. But 25.23 is really, if you start getting closes above there, you want to be a little bit concerned. If this is healthy, you really want to see this come back down to the lower part of the range. So the dollar is taking off a little bit of the pressure. What is not taking off pressure is the bonds, the TLT. I've shown you this in the past in the longer term time frames. Let's see, 15-year weekly. Yeah, take a look. This is the crash of 2009. And we are way above those highs. So the end of the world here happened, and we are now still above those highs. Why is that the case? And what does that mean for the markets? I think the bond market doesn't get enough discussion. That's okay. I studied this quite extensively in college. A lot of you don't know, but I did go to a very expensive and very prestigious business school. I went to the Stern School of Business at NYU, and believe me, I've spent more hours than you can count on studying bonds and all of their nuances, as well as Federal Reserve policy. I will tell you this, though. In normal situations, everyone always says, oh, bond market is going up, the stock market should be going down. That is completely wrong, and these people are, I don't want to say idiots, but they're dumb. So you take that as how it may. Stocks are valued on what's known as a discounted cash flow model. There are a few other ways to do it. There's some dividend discounting models, but that's really not as applicable here. I use the DCF method, the discounted cash flows. And all you have to know is there's a numerator, that's the top number, a denominator, that's the bottom number, and an end product, the lower number. The numerator, the bottom number, is comprised of interest rates. When bond prices go up, the interest rate goes down. That means the denominator goes down, and that means your end product is higher. So that means higher stock prices. That's all you have to know. Low interest rates, meaning higher bond prices, good for stocks. Lower bond prices and higher interest rates, not good for stocks. Their bond equivalent yields I don't want to get too fancy here. If there's enough interest in this, I will do a dedicated video explaining this in painstaking detail. Just leave me some comments and let me know what you think. But for now, this is the case. So this is really what supported the PE multiple in the S&P 500. Why are we rallying here and the market has been struggling? Because people are afraid that we are going into recession. I will cover that in a little bit when I discuss the Fed keys. But when interest rates get this low, and I'm talking about below 2%, that is not a healthy, normal rate of interest rates. Keep in mind, when markets tend to peak, they tend to peak when interest rates are around 5 or 6%, and I've argued that we are going to be in for a new normal, and the Fed has confirmed that when they had their leak over the summer with their interns' notes or whatever. They said they were going to normalize at about 3.5%. I had been hypothesizing for months before that. If anyone really cares to go back and check out the record, I said they'd normalize around 3.5%. I didn't think we were going to 5 or 6%. That is great to know that the Fed is thinking that. The problem is their path to getting there is troubling. They had been saying that they were seeing some inflation. You know, they came out with some minutes. I'll just get to those minutes right now. I took some notes on. I said it was a total punt. They said that their risks, there's no longer a balanced outlook. I don't know what the hell that means. Either, things are good or they're not good. I took it as that not good, but they didn't want to come out and say it. I guess they wanted to spare themselves the embarrassment of their policy error. They talked about they're monitoring global developments. They did say that the labor market improved a bit, although the numbers lately, I've told you guys, have been absolutely terrible. I'll get to that in a little bit. Maybe we'll take a detour here. We'll jump into the Fed keys, and I'll weave it in because I really do think it is applicable for this. The labor market, these jobs, they've been a lot of part-time jobs. I think a lot of companies are offshoring or part-timing because of Obamacare to avoid the Obamacare tax. So, they keep talking about the labor market improving, but it's improving in really crappy types of jobs, not high-paying jobs. And now with the problems in the oil industry, those are really high-quality jobs that are really high-paying, and they are laying off like a ton of people. So if you were, drilling or driving a gas truck in the shales for a couple of, $100,000 a year plus benefits, now you're waiting tables at Fridays or Pizzeria Uno. That's a pretty big step down. They talked about inflation slowing. I mean, we see oil down like every other day, right? With a couple of day respites. And copper and all the commodities we all know have been an absolute free fall. So thank you, Janet Yellen and company, for stating the obvious. They downgraded households and businesses. Yeah, I mean, obviously, things aren't going that well. Business investment slowed. I mean, companies aren't going to keep building pipelines and, invest in oil or any business if the economy is slowing. I mean, we have stall speed growth. They talked about the trade imbalance. What's new? We're getting ripped off by the rest of the world. They keep talking about this transitory oil. I guarantee you, if this happened at a private fund, like if this happened at JP Morgan, for example, all this transitory talk, you'd have congressional hearings. These people are absolutely incompetent with their forecasts. They've been incompetent with their global growth forecasts, and no wonder we are in the predicament we are in. They continuously talk about more growth than we actually get. They're living in this type of fantasy land. The IMF is as well with their projections for, they keep talking about Greece growth, and then they have these negative numbers, and they're like, oh, well, what happened? The corn doesn't grow as high as the eye can see. I mean, you're lucky at this point if it's even up to even if it's up to your knee. We did have some good numbers this week in terms of consumer spending and outlook or whatever. They're, the consumer sentiment. But consumers are what they are. I mean, we live in a material world, and these people don't understand until the proverbial shit hits the fan. Sorry to get a little four-lettery here, but hey, why not? People don't really kind of pull back until maybe it's a little bit too late. Plus, they run up their credit card balances. So anyway, we talked about the jobs. I said that they weren't so good. GDP, I know the Atlanta Fed has been dancing around. They took it from 1.1 to 2.2, and this is still really rather junky growth. We haven't been doing well. I mean, you saw what happened with Nordstrom's. They had that junky number. They had a really pretty crappy retail number. Let me see, JWM. Isn't that Nordstrom's? JWN, is it? Yeah, there we go. I'm saying M. Yeah, you could see they got nailed here. People did buy it back up, though, a little bit. So you got a little bit of a range here low. It's trying to hold a higher low. If you lose the Friday low, it's a short. If it takes the high, then you probably get a bit of a gap fill. I mean, I think everyone pretty much knew this at this time. Macy's, the same thing. They're reporting this week. They're probably going to have a pretty junky number, but I think people knew this. It went down and then kind of closed back up a bit. I guess you could use these double bottoms here in the 37.73-ish, 71-ish, or really the 50 MA. Let's use a 50 MA as our guide there. Let me just bring it back to TLT so we can stay in place here. The durable goods orders, we know that Boeing has been falling off a cliff. The Fed had highlighted, durable goods as, one of the strong points with planes and autos, and we know that they are now cutting their 747 growth. And, they've had, I guess, some accounting irregularities. I'm sorry this chart looks a little bit, used. Ridden hard and put away wet, so to speak. I have multiple Fibonacci time frames here. The important one, though, is that the 61.8 here on a smaller time frame did hold. We did get back up above primary trend, and we are kind of consolidating. So I would say you could use these lows in here. They had a flash crash low here of, if I can get over there, 115.14. Close here was 115.16. So we are really at the, consistently lower lows here. This was a bounce. So, if you get below this flash crash low again, you don't really want to be long the stock. If you can take the multi-day range high here and get back up above the 20, which is stalled here, then I would say you probably could have a little bit of a rally, maybe back up into, this breakdown point, into the 127s, 128s. You do have stochastics bending back up, so it's probably in for a little bit of a respite, but this is not really a very healthy chart pattern. It did break through the lower part of the channel. It kind of, I guess, held the primary trend. So I guess, if you want to play long, just do it against the flash crash low. So it's kind of right or right out here. Let's be even a little more specific, since you're not going to not be long, buy it and then be out in 2 cents. Use the lows here, the 113.99. Anything closed below there, you don't want to be long this stock. Anyway, autos, Ford, these companies have been reporting decent numbers. They can't get themselves arrested. Not doing well. GM, not doing well. These stocks are all at multi-year lows. Really quite pathetic, if you ask me. I talked about the dollar already, and then the last bit that the Fed looks at is, of course, the S&P 500. So, I think that the move in the S&P probably should have given the Fed a little bit more pause than it might have. This type of flash crash action, but you can see there was a bit of a rally into the end of the year, and I think the Fed, not being technicians, didn't quite realize how vulnerable the market really was, and we've paid for it. I will cover the S&P. Actually, I'm going to bounce back to the 6 market keys because we didn't finish. We got through the VIX, we got through the dollar, we got through bonds with some detours. The big daddy, the Mac daddy, I usually talk about USO, but I want to talk about CL. That's just the futures version of the USO. That's the real market. You had a bit of a gap here. This was based on the futures contract rolling, and we've subsequently sold off a bit here kind of to fill in that gap, to kind of normalize. Like, this wasn't really, it had been up, but this gap was a little bit more than, it wasn't based on price action. It was just on the futures contract rolling. Anything below 33.20 to me remains vulnerable. Really, 37 to 33.20, that's really the key that you need to solidly get over to kind of say that the lows might be in. I don't know why this chart keeps jumping around. It's making me a little dizzy. But anyway, the 50 MA here is clearly important, and we really need to get back up over that area. The 50 and these 3320s are basically, the break. We're really the breakdown point. This was the 2009 crash low. It looks like we are trying to form somewhat of a bottom. It always gets a little bit choppy. So let's see where we come down to here. Ideally, you would put in a higher low here, and once you can clear over the 3482, which is kind of the range high, then maybe we see the 37s and potentially even the 40 area. That's sort of what I'm thinking. But crude has been important. I saw some articles saying that we broke the correlation with crude. That is complete nonsense. Don't listen to that. I'll let you know when we break the correlation. I'll tweet it out. How's that? Or I'll mention it in the weekend review video. We are still highly correlated to oil. Someone asked me, a few people actually asked me, which oil stocks should I buy? Should I buy the beaten down ones and the ones that, have cut their dividends and have been beaten to crap? Why not just buy the one is going to be in business forever? Exxon, Chevron, the ones with the big dividends, with the solid balance sheets that have been in business for a while. We are getting a little extended stochastically. We are up into a bit of a resistance point. However, I do like that we are starting to form a channel here. There could be some room up. I do think that there will be. I do think, and I'm going to go on the line here and say, I think Exxon at some point, I don't know if it's going to be in 2 weeks or in 2 years, but at some point, I think this stock will be a $100 stock again. So let's see how that goes. That's my call for Exxon. I think it'll be a $100 stock again. I don't know that it won't be a $73 or $75 stock first, but I do think that at some point we will see $100 again. I don't think oil, as Rihanna says, no pain lasts forever. I don't think the oil, that with all the production cuts here, with what went down now, the Saudis and the UAE saying they're going to do some production cuts. What I really think happened there is I think Putin told them that they had an opportunity here to make some oil cuts voluntarily, or he would make it more mandatory. And you don't want to mess with that guy. So you've broken some trend here. You're in a bit of a chop range. So what I would say is buy the lower end of the range and sell the higher end of the range. Nice, quick trade there. It has a decent yield. Exxon is my favorite one of all of them. China. Gotta have your China, right? So China. You had the blow-off, subsequent beatdown, the check back, and now lower lows. We are, however, down to a reference low. I will show that on a longer-term time frame. Let's just do 10 years for the point of expedience. You snapped the trend here kind of falsely, got back above. Once you really definitively broke it, you filled up the triangle down to these lows. Had a hammer and a bit of a rally. I do think we're in a bit of a consolidation period here. There is obviously a lot of overhead supply now up here in the 30s, the mid-30s. I do think at some point China will bottom. I can't even believe I actually just said that. Of course, at some point everything bottoms, right? But we are still in a period of making lower lows, lower highs, and still lower lows. So, your guess is as good as mine. If you want to buy FXI, I think you can own it. Small size, right or right out against these lows in the 28s. You could probably use this here, this pullback, this low here if you want to use 28.46 or whatever. In this area, you don't want to be long if you start breaking this again. I don't mind buying it down here for right or right out, or if you want to buy it up here with right or right out with a stop below the gap here, 29.97. Or you could use let's use the 20 MA. 20 MA resisted here. We're back above. It should support now. If the 20 MA doesn't support, look at this here. The 20 MA was a lot of resistance. We did have some brief looks above it, so maybe, see if it supports here. If it holds, probably going higher. We do have some stochastics on our side. Maybe we get a run back up to the downtrend into the 30s look here. The higher low here was the 33.35. That probably will be some resistance that you can see is where the volume distribution really picks up. Maybe if you have, some good news and we break, maybe you get back up to like the 35s, 36s. But I would play it that way. The Baba. So this might be a higher low, double bottom. It kind of held the backside of the old downtrend. Had a bit of a rally back up here to sort of where this volume was, the breakdown, and is just stalling. 20 MA, you want to use look at the pullback low here was 20 MA. Let's use 20 MA stop if you want to play long or if you want to add short. What I wouldn't mind seeing is this to kind of consolidate, and if you want to play it on a momentum over 68.50, maybe you got to move to the 50 MA, which is also these range highs. There's also some resistance back up here in the 71s. It's not quite as evident on this chart, but I assure you I followed this stock quite a bit. That area to me is going to be some I think some stiff upper lip resistance for a little while. But I think if you want to play it long, 20 MA is as good of a place to play it long against as any. Let's move on a little bit. I was going to cover Baidu, but we're running a little bit behind schedule. IBB, oh boy. This thing is just really not very pretty. It's looking very toppish to me. We're almost at, I think we were going to get 100% retracement here. We might even overshoot and get the primary trend. I don't know how that's going to coincide, but we snapped tertiary trend. We snapped secondary trend here. It's pretty ugly. It wouldn't shock me to see a rally back up, maybe to the real breakdown point of 306, 50 MA touch or what have you, but this is to me looking a little bit iffy. It doesn't surprise me that we didn't just completely drop through to Hades here. Look, you have a lot of reference lows here and here. I think there's some responsive buying, and it just was so much so fast. However, why did this happen? Obviously, you had a technical breakdown, and that's always the most important part. Head and shoulders, snap, this was a pretty big snap. Retest of the breakdown, the neckline, break again, equal to higher lows, kind of retested the downtrend. Looked like it was forming a bit of an inverse head and shoulders here, although it did retested again up here. This really should have gone to the upside, but it didn't. It broke to the downside, and once you snap these areas, look what happened. Just free fall. So we're trying to get our sea legs back again. I like to see when patterns change first. A lot of people like to try and catch the bottom. They feel so smart, but the problem is it's very hard to catch a bottom. Because where is the bottom if you don't have higher lows and higher highs? There's no trend to be drawn in. The trend is still down. We are really bombed out stochastically down here. Look at this. We're as bombed out as we've been in quite some time. It probably is due for a bit of a bounce, but my real concern here is that I think the ETFs is weighing on the stocks, and then when they sell in the stocks, it weighs on the ETF. It becomes a self-fulfilling prophecy. A lot of people buy in these ETFs now, and they kind of become the story, believe it or not. As crazy as that sounds, the ETFs kind of become the story. And I also politically, we know Bernie Sanders, Hillary Clinton, and even Donald Trump have been talking about negotiating lower drug prices. That means that these stocks could be in for peak earnings. Look at these stocks like Gilead that trade at low multiples. They are not trading well. What these are trading to me this to me looks like it's in a big topping pattern. So you got to be a little bit careful. Flash crash low was 86. You can see the breakout really was 84, 88. If you want to be long, that's sort of the area. If that breaks, you could even fill up the triangle, believe it or not, down into the 60s. I know people are I'm gonna get a ton of hate mail on this. I get it whenever I make these crazy calls, right? But they always seem to kind of happen, right? No one can ever see it until it happens. You have a ton of supply up here, and if you snap this again, I think that you could see a pretty nasty cascade. It could even overshoot to the big 61.8 and the 57s, where I think that this stock would be a pretty screaming buy for at least a right or right out type of a play. But you could see a little bit lower in this Gilead. I'd be a little cautious. All right, let's just get to it. The market, the big market, the S&P 500. The Mac Daddy of all indices. I like to talk about it in SPY terms because a lot of people hold that as their proxy. SPX is a little expensive to buy. Not everyone trades futures. SPY, good, right? Pays dividends. You have this sort of side of the mountain, the other side of the mountain. We are now trading on the other side of the mountain in a policy error world. You can see here that we have a bit of an inverse in head and shoulders in the stochastic that seems to be breaking to the upside, a bit of an inverse or cup and handle, whatever you want to say. So we do have some time. The stochastics, we could conceivably continue to rally. I will say this, though. Look where primary trend is. Look where the reference low is. Look what the symmetry is like on this. If these lows here were to go, these 81s, I think we would see this 73 rather quickly. And the fact that we have this double bottom, 1, 2, 3 bottoms, and a consolidation range, I don't know if this will hold. I could conceivably see this having an even larger snap down to where? Down to the 2000 and 2007 retest of that breakout. We never really tested it. We kind of broke out. We had a bit of a mini test here, but then we really rallied. If you draw in some Fibonacci's from the pullback low here, this is really where the bull market got. I would say this is really where the market got started. I mean, the low in March of 2009, but after the debt ceiling fiasco, we had a bit of a channel here. We've broken that channel, and we've been consolidating below it, which is a little bit dangerous. I drew in a trend line here. I would think at the very least it's been a really long time since we had a primary trend. It probably will hold at least the first time, maybe. I really actually was kind of hoping that this was going to fall apart harder and have a retest to the primary trend right at the breakout area. But of course, the market doesn't always do what you want it to do when you want it to do it. In general, you can see the 200 MA on the weekly we have traded on the wrong side of it, but it has been a bit of a hold. So this is important. When we really lost that, we did have a little bit of a look back here, but after that was really the crux of the crash. You can see where it held. We rallied back up to the 50. I want to get into more modern times here. Let me just finish that thought up. We got back into the 50 here, then completely really fell apart. So if history is repeating itself, and I'm not saying that it is, we'll have a 200 touch, then a 50 touch, although the 50 is a lot higher. I think if we got back up to this 50, people would really kind of think that everything's okay. It's Miller time, but it really might not be. That could kind of be the amazing right or right out short that could last, for maybe hundreds and hundreds of points on the S&P and tens of points in terms of the SPY. So keep that in mind. That's not really something I've discussed publicly before, but you've now kind of seen the inner workings of my mind, at least with regard to SPY. In a more narrow and more, I guess, today time frame of what might happen this week as opposed to what could happen weeks and months from now, we have a Fed range. A new Fed range. Look at this also, all this chop and consolidation here. You have a Fed day range. That's this day. If we had a bit of a look below here and fail. We got back up. That is 191.56 and the low is 187.06. If you lose 187.06, you really want to be, I think you want to be pretty short for a move to retest these lows and probably hold for a break below there. There might be some kind of minor bounce and then a complete, drubbing. But I've been thinking we probably want to see the 50 MA again. Maybe it coincides with these highs. You really want to be cautious, and I don't really think you want to be overly aggressive long until you've kind of had a resolve of this W. You see, you have this. The swing point, a retest, a successful test of the low. If you can get back above here, this 194.58, and I think the expected move this week is $3.74, which would mean 195.74 or 188.26. So I don't know how that's going to play out, but the 50 MA, it's a declining 50 MA. It seems like it wants to be tested. It would be something, if it coincides with here, that to me would be a good right or right out short for at least for a intraday pullback. If we can really get some momentum and break above that 50 MA and the swing high, we could rally as high as the 197.86, which is sort of the low end of the consolidation box. Maybe we even push up to the 61.8, which really would coincide also with the downtrend and these prior. You look at these. We had 3 bottoms here. Look at this. 3 bottoms here. That would coincide with where we really, you see, we kind of had this gap down. They kind of tried to rally it. They couldn't do it. And this is really when we definitively broke here, is when we completely fell apart. So I do think that there's a lot of price memory up around this like 199, let's just call it 200 area, and like maybe 202. This in this area, because look, this is where these lows were. This is where the bodies were. I think in these 2 points is going to be a real healthy amount of resistance, particularly if this does this in like gap and strong fashion. I'd be looking for a major opportunity to try to do some right or right out shorting against that trend. Of course, if it breaks, we're a little bit cautious, but that's sort of what I'm thinking. Let's talk some financials for a minute. Let's start out with Goldman Sachs. I know a lot of people took a little bit of heat last week for not talking about this, although the analysis was really the same as the prior weeks. Head and shoulders top, very clear. We in a breakdown here. I've been waiting for a trend line touch to try a right or right out buy, particularly if it could coincide with the these lows and the 50% fib. Didn't quite get it. Had a bit of a retrace here to the 151.65. You could see where this low is, and a back off. Ideally, the ideal situation would be a rally up to the downtrend, right where the neckline breakdown was, because you have the head and shoulders breakdown. You don't have the check back yet. So I don't think the real pain. I mean, this is a lot of pain. I mean, don't get me wrong. If you own this from up here, you probably should not be around sharp objects. But I would love to see some type of a move back here, preferably on earnings, and to the downtrend and to the neckline breakdown, and set that up as a right or right out short. So I'm thinking with Goldman, you probably could own it again if we had a little bit more weakness down to the downtrend line that coincided with the 50 or these lows, and then play it long for a check back and then switch short. That's just my thinking. You can see we're kind of in a bit of a triangle here. You kind of want to buy on the low end of the triangle, considering we've come down so much, and then play for a move up. But big short term, I guess I think it could maybe rally. Bigger picture, I think it's looking bearish. JP Morgan, we know Jamie Dimon bought. A lot of people were expressing a lot of skepticism about his buy. I mean, listen, it's 25 or 26 million bucks is a lot of money. So this pattern, this chart isn't as bad as one might think, although it's not like, the worst out there. This was sort of the island reversal. You had this gap down, and then price rejected quickly on his buy. Look at where we are, right on the 20 MA. 20 MA kind of supported a little bit here. Once it definitively snapped, that was the trouble. So we could use that as a buy point, for right or right out. I think that there'll be a little resistance at the 50. It's not a surprise that there's a little bit of selling that's going on, because you had some people who were playing by the dip in this area, and when they get made whole, they want to kind of get out. But I was actually hoping we would have seen the primary trend again in JP Morgan, preferably if it coincided with the flash crash low, which was 50. Unfortunately, Jamie didn't wait. I guess he wasn't listening to the technicals. So I'm a little bit careful. As long as you could kind of hold this halfway through this body here around the 56s, though, you're probably still okay if you're long. Even better if you remain above the high, the 57.57, which you are. So I would say you could use the top of this bar or midway in if you want to play long. Right around here. If it gets below there, you probably want to be a little more cautious, or even, dare I say, try short. So a lot of people were asking me about this deer during the week, and my call was that I thought we had rallied a lot before earnings, and they tend to not be so great when they report this company. A bunch of misanthropes. They tell a terrible story, and we were down like I expected. We are now, however, holding. There's a couple of things here. There's a few ways to look at this. One is that the stochastics have kind of peaked a little bit here. Two, we didn't even get a test. Look where the breakdown took place, the 200 MA. We didn't even get a test to the 200 MA, so that shows a little bit of relative weakness. However, we did have this gap down, and a lot of people I know are looking for the triangle to fill here. It's possible. However, look where you gap down to. You have a 20, a 50, and a 100-day. This is the 100, this is the 50, this is the 20. So a lot of moving averages there and a trend line. I actually think it's a better right or right out long versus the trend than it is to initiate a short, considering we are in a bit of an uptrend. If this were to snap and you lost these lows, then I think you can play short for a move, back down to 70. Very simple trade. So I think right or right out long, and if wrong, flip. Very simple. IWM. Alrighty. Okay, so IWM, you can see also with this kind of big topping pattern, very weak. We're below the consolidation box. We even broke down below the double bottoms. I will say this, though. The bulls have a bit of a case here. This here was clearly a look below and fail. I would say it was quite an island reversal because there is a little bit of overlap here, but I would say it's still a bullish reversal pattern. Look below, fail, rally back up into range, and now consolidate. You have 3 days of consolidation here and a 20-day moving average. 20 was resistance here. It was kind of a little bit of resistance here. We did have 1 day that closed above it, and then after that it went down. So you really need to see confirmation of holds. Here you have 3 days. So what I would say here is if you lose the 3-day low and the 20, it's short. If you take out the 3-day high here at 101.09, you probably have a little bit more room back to retest the backside of this downtrend line. Look, trend broke, it retested, you made a new low, and now you're just consolidating in range. The overall big pattern is bearish. Here, though, you happen to have a potential for a bullish reversal. So it hasn't really shown its hand yet. I would say you really need to take back into the trend line. I mean, you're going to have a lot of going against you. You have a reference high, the backside of an old trend line, and a declining 50-day moving average, plus a fib retracement and a reference low. So there's, look, there's a lot going against you here. This to me would be I would say it's probably, you could do it as a right or right out short, but you really shouldn't be back here so soon, particularly after this failure with a new low. So I don't know if I would be playing so short if you get a break down here, because it really shouldn't be back there so quickly. That's my take on the IWM. Qs. All right, so the Qs are the most bullish of them all. Look at this. We're still in the box. This is the big consolidation box. As long as you're in there, it's sort of like the Dumb and Dumber, right? So you're telling me there's a chance. The answer is yes, there kind of is still a chance. Let's look at this a little bit closer. Roll that beautiful bean footage. Again, a 20-day moving average hold, 3-day consolidation. You have a lot of reference lows around this area here in the 98s. You did get a little bit of a look below. However, the 61.8 for the most part, a lot of people like to play this to the tick. I tend to notice there's a lot of overshoots and you miss a lot of opportunity sometimes. I really was hoping for a primary trend touch that coincided with the 78.6. However, we didn't quite get that. This is starting to be one of those markets where you don't get the real pullbacks, the full, I gave the example of a slingshot. If you kind of half cock a slingshot, that you do get forward motion, but you don't get the real full forward motion, as opposed to if you fully cock it, you could get that real motion. So I'm a little cautious with this. Cautiously optimistic, but cautious nonetheless. You're above the 20, which is good, but you still have now a declining 50 MA ahead of you, which is right around a key old support level. You can see the 50 held here. It could probably resist here. And you have the 50 and the 100 both above you to be a little bit some resistance. You also have a lot of relative weakness in some of the big tech stocks, like the big daddy Apple. And it would help if I could type. Here we go. So Apple also looking like a big topping pattern, looking like it wants to retrace to the primary trend line. It looked to me here like after this minor bounce here ahead of the 92 that, let me get rid of this. It was also the down channel line. that we kind of bounced, rejected the 20 and coming back, it looked to me like we were going to finally get the old snapperooski, but instead we got to move back up. However, the last few days, and we are starting to come back with the stochastics, you had a move up and then a move down, and now we're kind of just hovering around here. You have a declining 50 MA. I do think at some point we're going to fill the gap here to the 100 again, to the 100 to 172. That was the old top back before the split in Apple. Let me see if I could show that 5-year daily maybe. Yeah, look, you could see back here. I think there'll be some type of a move back to there, and then I don't know how that's going to play out. have been waiting for a primary trend touch for a while in Apple. It is possible that snaps and we get a full round trip here to refill, to the 75, area. If, the market really completely falls apart, maybe we do get a retest into the 55 level. I don't think that's going to be what the case is. I will say this, though. If you're bullish and you're long, you got to be using 92 as your stop. Any break of this consolidation, these consolidation lows, which were 92.39, 92.59, 92, any break of 92s is not going to be pretty, in my opinion. I think you'll see the 85, and maybe it coincides with the 85 and a trend touch. That, to me, would be like the ultimate right or right out type of a buy. But, Apple's not really showing its hand here. It's just kind of consolidating and chopping. I know Carl Icahn had some sales and a few other guys had been selling. So as long as we're below this sort of 103.74 to 103.12, I remain cautious. I do think that Apple will have a move higher at some point, but I don't know that it won't have to go lower before then. This stock tends to trade on new product releases. You do have the new iWatch or the iWatch 2 coming in March. I do think and predict that that's going to do really well compared to the iWatch 1. I think a lot of people like myself are waiting for the better battery life and, you don't buy the first generation type of a thing. My grandfather always taught me that you don't buy the first generation of a car. You wait till they get the kinks out. I think that's what people were thinking. I've even talked to Apple Store employees who've confirmed this. So it's not, this isn't really opinion. It's kind of really, I would say, almost like fact. Anyway, that's neither here nor there at this point. I think the 50 MA is a good right or right out short. I think the trend line and the 85 area is a good right or right out buy. Let's just get into FANG. That's what everyone cares about these days, right? The sexy FANG. So I am bullish on Facebook long term, although I have said for a while I'm a little bit cautious short term. We got above what I have dubbed the progression line, and that's been real trouble in the past. You can see up here, even way in the Wayback Machine, it's been problems. We came back down. We've rallied a bit here. That's what it tends to do. You get these choppy, false breakdown and sideways. So this is just kind of everything's going according to plan here. Consolidation. As long as we're above 99.24, I think you could be long. If you want to be even kind of quicker on the draw, use the 50 MA, which is 102.91. Anything above the 50 to me is still bullish. You could use a closing basis if you like. Anything below the 50 to me gets a little bit more iffy. I would love a move down to this trend as a right or right out buy area, particularly if it coincided with like mid this range or low this range. That to me would be good. You can see the 200 MA here on closing basis has been also really strong. That's down around the 90, almost 95 at this point. You could use that as a right or right out area, or if you want to sell out of the money puts, that's a good level to play it against. Amazon. So we never quite got the full 100% retracement. It's bouncing a little bit here, although you have 200 MA resistance. So if you want to play Amazon, I would, and declining 20 MA resistance. You also have this consolidation range. So there is, there is some resistance up here around in the 540s. I would love to see this make a move back to the downtrend line for a right or right out short type of an area. Or wait for this to roll over some more and maybe get it as a buy a little bit lower. In here, if you want to play the day trading game, play it against the, this candle day. The high there was 541.20. If you're short, that's I would say, probably a good stop. Anything above there to me is probably got a little bit more room. Anything below this day, because look, you went below the trend, you got back up above here, you had a bit of a look below and fail above. So if you lose this 515.35, I think it's probably going to want to retest these lows and maybe even go lower. So those are the keys in my view. The Netflix. So Netflix was a bit of a CT this week. You did lose the flash crash low and did get a little bit of follow through, but really not all that much. And it kind of rallied back up, came back down with a higher low. And then this day, I will admit, had me scratching my head a little bit. I didn't quite bite long, but I was starting to think that maybe the pattern was breaking just because you were over the this after hours dump low, and like sort of looked like you were starting to break the regression line. However, look at the next day, really closed rather weak, and then even on Friday, you closed below that breakout bar. I do think longer term, and I've said this for a while now, and it hasn't quite played out just yet, although I did talk about this being double top, and that has played out. In the snap here, you basically filled up the triangle. The real breakout here was around $70. I mean, I have seen some street analysts talk about a complete retracement here to like the 45, 43 level. That was also the 2007 area. I don't know that that's going to happen. If you did get a move down to like 63 to like 70, that's the primary trend in the breakout area. I would be personally, I would be a buyer there. I'd probably at the very least sell some puts. You are, however, here bombed out stochastically. It's probably due for a little bit of a bounce. I don't really like shorting lows or breakdowns on these. I like to short rallies back to like trend line or to past breakdown areas. I don't like to play like this breakdown, but I would be interested in playing it against the, I don't know why this line is green. It should be red. Very annoying. So if you could get to this downtrend line, I would be interested in a right or right out type of a short, depending on how long it took to get there. And it would be even, better if it coincided with a 50 and a 200-day moving average. I like to, and a past support level. That to me would be like the amazing area between 103.88 to 105, 106. I think that area here would be a good right or right out type of a short, particularly if it moves up quite violently. We'll see how this plays out. If it can make a bit of a higher low here. I'm not really super bullish or bearish on Netflix here. I was up here, so I can't be as much down near reference lows, but I am a little bit cautious on this. I would be more interested, like I said, between 63 and 70 if it ever were to get there. Google, I really don't see an edge in this stock at the moment. It's just in one of these kind of chop consolidation modes. It did get up to the channel, close to the channel high. I do think at some point it's going to work its way down to the channel low. I would be a buyer on the channel low. Just my opinion. As of day to day here, it's a little too whippy for me. I don't have, and I think there are easier stocks to make your bones in, so to speak. Might want to play a strangle at this, or some type of credit, iron fly, or I don't know. There's a lot of ways you can play this. Condors. I mean, there's ways to play this. Price line. Okay, so you had a breakdown of this up channel here. You broke a trend line. It's a shame that this really rallied so hard as it did above, into their number, and then it rallied again, which was good. However, this is now from the low here, kind of the double bottom or look below low, to the high here on Friday. And notice where I have that oval drawn in. Let's delete that oval. You are now a full $330, almost $331 off the low. And you are to a gap fill where the real breakdown took place and a 61.8 Fibonacci retracement of this move. And the backside of, you're slightly above it, but for all intents and purposes, you moved a little bit above it here, you're going to move it a little above it here, also a volume distribution, the backside of the prior up channel, and the 61.8. This to me is probably a good area, believe it or not, for a right or right out short. Right or right out. At the very least, if you had the genius to buy it down here, probably want to take some profits. If this doesn't hold it, my guess is you'll see up here close to the 1345 number. I don't know if you're going to completely fill this gap, although probably longer term you will. But up here, at the very least, I think you'd want to take some profits if you're aggressive right or right out short. Chipotle. Getting back up close. I had said last week I thought that this was probably a long. We're getting close to the target. Had a bit of a reversal bar here. I'd be a little cautious now getting here, although I would be interested in playing the buy the dip game in this now. I kind of think that the basically trend held. You're basically near an old top, which is now supporting. If there was a big move down in this, I'd probably sell some out of the money puts. I would love this at a trend line or a 50 MA. You can see the 50 is starting to bend, the 20 bent. If these were to coincide and this pulled back, I would love that as a right or right out play. So I'm bullish on Chipotle longer term, but short term getting a little cautious up into this area. That's my take on Chipotle. All right, so let me do WYNN quickly. So WYNN is now also one that I said I thought was looking a little bit more bullish. Look at this, higher lows, higher highs. However, you're into some reference. This is up a lot fast. Higher high with close to a 200 MA and a reference high. Probably a good idea short term at the very least to take some profits. Longer term, I think this will go into the mid 80s, probably even 100 again at some point, but I'd be a little cautious. You have a high here bookended by two lower highs, so this could be the high for a little bit. I would be looking to buy down in this area, right, in the mid 60s for some type of right or right out, preferably if that coincided with this confluence of moving averages. So WYNN I'm bullish in, but short term I'm a little bit cautious. Let's end on IBM, I guess. This got an upgrade. It bounced off it had these lows. It's rallied back up, really. It got a little bit steep. You're back to a kind of the backside of where the old bottom side of the down channel was. Coming into some resistance. I would like to see this build out for a few days and work off a little bit of this move. It's a lot quick in this name. I don't really think that their business model is improving. If you must own the stock here, I would say wait to be long over 34, and you want to use a stop below 29.75, the gap day high and low. That to me is always what's important. This day was important. It's a hammer. It's kind of an inside body day. If you were to lose these two, I think you'll fill the gap quickly. If you break out, particularly if you spend another few days going sideways and then take it, that would be even more bullish. So with that, we'll leave it there. Anyway, let's also one last thing. Look, you have a downtrend line here. You have the backside of an old channel. You're consolidating here. If this were to break really convincingly, I think you could have a lot more room up. So let's just wait to see which way it breaks. Anyway, with that said, let's have a great trading week. Please leave me some comments. Your comments help me make the videos better. If you're not following me on Twitter, my handle is @JustinPulitzer. If you enjoyed this video, hit the thumbs up button, hit the subscribe. You'll get notifications when I post these weekend review videos, Periscope rebroadcast videos, special edition videos, all that good stuff. Anyhow, let's have a great week and cheers.